What's going on? Jake with Chain Genius, back for another episode of the Crypto Daily Update, March 20th, and the markets have decided to smile upon us. We've had a little bit of a rebound up to 345 billion, so that's a nice sigh of relief, especially after the downward trend and dipping our toes down to that $275 billion market cap level. Looks like across the board, pretty much a sea of green, couple red spots, Bitcoin's leading the charge. Some of the smaller caps are obviously doing a little bit better. That tends to be how it is. Those that fall farther also bounce higher, generally. So that's pretty awesome, but one thing to keep in mind and maybe be a little bit concerned of is that due to Tether printing about 300 million new Tethers as of today. And the reason this is generally, in my view, a potential problem is Tethers can be used for leverage trading. So essentially, it allows me to outsize how much money I'm going to be using to manipulate the market. And a lot of these whales, there's an account called DFINITY, and granted he's a little bit crazy at times, but he makes some valid points, and he's actually been banned from Twitter as of right now. But one of the things he talks about, and I personally agree with, is when you're leveraging that much capital times 100x, you're able to play what I call volleyball, which is allowing you to manipulate the market into a froth where I can buy and then sell to myself over and over again and eat a small amount of losses while I passively move this price slowly up on a single exchange. And then what I do, of course, is once I'm at the top price point or when I'm ready to scalp everything, I just dump all my sales, and generally the net losses I've suffered moving the price up a certain percentage are offset when I sell in bulk. Is that the case? I don't know. Maybe there is some positive sentiment because a lot of good news has been coming out in the space, but it always makes me a little concerned that whenever tethers get printed, there tends to be or appears to be a correlation of price moving up. The other big news today is CryptoKitties just raised $12 million from Andreessen Horowitz and Union Square Ventures, both two very large players in the space. And what's happening is CryptoKitties, for those that don't know, is a collectible card or a collectible cat game where you can buy and breed cats, which you can then in turn sell. And this was started by a venture studio called Axiom Zen, who's going to be spinning this property out as a standalone app. And while right now, CryptoKitties in its current form is pretty much similar to a pyramid scheme in the sense that whoever gets in first is going to make the most money, because the way the game worked is the earlier cats had lower generation numbers and usually had access to better traits. And then as you bred, those generation numbers increased, or the number of times that a cat bred slowed down its breeding pace. So the earlier you were in with the older, more rare cats, the more money you could make. And back in the heyday, it choked the entire Ethereum network. What's really cool about this, and I want to make sure people don't gloss over, is CryptoKitties itself is kind of dumb. In its very current form, there's nothing, it's not a game. It's a proof of concept. Where it gets really fun, though, is the ERC 721 protocol. And if you don't know what that is, I highly recommend you check it out. There's actually a great Reddit thread that gives you an ELI 5, explain it like I'm 5. And if you understand ERC20s, which is most ICO tokens, ERC 721s are non-fungible tokens where each one of them are distinct. And the coolest things about these is you cannot divide them. They have to be a multiple of 1. So imagine houses, cars, baseball card games, anything that's a non-fungible where each one's slightly different and unique. That's where these really become valuable. So if currently the biggest place that this is being used is in video games, because collectibles, baseball cards, Tamagotchi, Pokemon, whatever you want. But if you imagine like a video game where you have an inventory with 5 wands or 5 arrows, a sword, a fish, well, each of those 5 arrows are a distinctly different ERC 721 token. And then this metadata is stored off-chain, either in IPFS, Interplanetary File System, or some other storage hash where you can then look up the additional metadata, because all baseball cards are cards related to baseball, but then the actual values of each of them is slightly different depending on the player. And where this gets really valuable is, of course, collectible video games. Think World of Warcraft if all the items were non-fungible and independently tradable outside of the control of Blizzard, Activision. That'd be really cool. The other thing that you could use this for is potentially with voting, where if I, as a voter, was given an ERC 721, even if I was given 100 million of them, in any general election, even if I vote 50 times, it's only going to count me as one unique voter. And that's really cool because it prevents double voting that can happen in a lot of these older systems. However, the one thing it still doesn't stop is even if I have to tie that ERC 721 to my identity, you can still open up multiple accounts or create false identities. So it doesn't solve that problem yet. But there's a lot of talk currently going on in the industry, and I think you're going to see a lot more of these coming up in the next year about how we can use non-fungible, unique assets on the blockchain. Because originally tokens or Ethereum, each unit of those are all the exact same. There's nothing different about them. The last thing I'm going to touch on today is about DFINITY. And this is getting into a bigger problem that I see in the ICO space where projects are not open, they're being driven by greed, even if they say they're not, and a lot of the use cases of the tokens are inherently weak. So DFINITY, that don't know, is a Gen 3 blockchain, decentralized cloud, so think AWS, Amazon, but it also has smart contracts. It's a full-fledged platform, so we'll keep it simple there. What they did, though, and this is coming to light through ICO Drops, is ICO Drops is a great site if you want to keep track of what's coming up in the ICO world. There's about 100 other websites that do this. And officially, this hasn't been announced, so this could still be changed or might be false information. But this comes from one of the SAFT investors who got in early in the seed round. And if you look at these numbers, what's really disappointing and obnoxious about all of this is that seed round investors, looking at this price, they got it for 3.6 cents. If you go into the main round, you get it for almost $7.50. That's over 200x of a return if you were a seed investor. That's selling it at the public price. That's no moon mission for the public. That's nothing else. And strategic investors are getting it at almost a 3x, which is actually over a 3x, which is absurd. So all this does is create an incentive for early investors to dump on everyone else's head. And are the key investors, seed investors, going to be the early user of the platform? Probably not. The other issue I want to touch on this is they're only selling 50% of the tokens. The other 50% are going to be held in a company reserve. Whether or not that company reserve goes directly to founders, it kind of doesn't matter. They're only selling 50% of the tokens, which means they're going to be valued at a $3.5 billion valuation, which means they're going to be listed within the top 20, and then take it as you want to gain gains and all this good stuff. The likelihood of it going from 3.5 billion to 35 billion, which is a 10x, not going to happen. It puts it in the top 5. Could it 2x to 7 billion? Maybe, but now we're scrapping around with some of the other big players in the space who are farther along than they are. Not saying that it couldn't happen. It's the same problem I have with Telegram raising whatever, $1.6 billion from investors. That means their market cap coming out is going to be in the multiple billion-dollar range, so there's not a lot of room to growth, or for growth. The other thing I have, the last final issue about this really is Ethereum managed to do what they've done with $18 million raised. 18 million. And they've created over $1 billion company. That's how it should be done. You should be raising for exactly what you need, plus enough runway to get to those milestones. And I get it with token raises, you only get one shot at this. Maybe you could hold more tokens in reserve and raise only 10 million, and then you do a second sale for another 10% of the tokens at 10 million, assuming you've hit milestones. It's getting out of control and upsetting because any of you that are investing in these projects and you're not doing your homework, I don't feel sorry for you when the market dumps on you. The other thing is, like DFINITY, I have no doubts that they're going to list at $7.50 and drop off a cliff. Because if I was a seed investor, I'll tell you right now, I would dump on everyone's head to grab a 200x. Even if I got 150x, even if I got 100x, I could turn $50,000 into 5 million or 10 million. It's absurd. Who wouldn't do that? And in this post, they give a response about like why and how they're doing things. And they mention, like I said, it's not finalized. These are subject to change. However, they claim that they're building into the NASA for decentralization, which that's great. I hope they build into that. That would be amazing. But you don't need $350 million for your first raise to do that. You have no product. You haven't proved it out. You don't have customers. What's the token usage on the network? You have to show some proof, at least for me as an investor. The other thing is using Facebook as an example. All bad news, outstanding. If Mark Zuckerberg had originally walked in front of Peter Thiel and said, I'm going to build it into what it is today, 1.5 or so billion users, $12 billion of revenue per quarter, global empire. Like, no one would invest in that. It's like, great, that can be on your future roadmap. Build to that one day, but how about I give you 10 million right now and see what you can build over the next 2 years. And then when you come back, sure, if you doubled, quadded in size and you killed all your milestones, sure, let's give you 100 million. I don't care because you've proven your track record. And everyone that does investing in this space is complacent and a part of this. Because another example I'll use is gems, and I don't want to beat on this too hard. I actually like gems, but I think that Rory and his team butchered how they handled the raise. They didn't need $72 million or whatever it ended up being. And when you come out with sale metrics, tell everyone, when I do due diligence into a project, you better be certain I'm going to find and I'm going to dig to find who got the best deal and what those terms were. You can try to keep it off of term sheets. You can try to keep it on an email, but emails leak. Telegram is anonymous. Signal's anonymous. Proton Mail's anonymous. That information's going to get out. And if I find out that you offered me a less than stellar deal when I'm investing into a project, I'm not going to touch you because that's garbage. You should be open and honest because in my mind, someone that invested in your project a year ago, 2 years ago, or is subject to a 2-year lockup, okay, fine. They're putting more money on the table. They're taking a bigger risk for a longer period of time. They should be compensated for taking an outsized risk. I appreciate that. But when you hide it, it just makes it scummy. There's no reason for you to hide it from a legitimate business reason. Anyway, that's the end of my rant today. I hope you guys enjoyed the video. Make sure to hit that subscribe button, ring the bell, tell your friends, and ask some questions. Until next time, peace.